Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to lesson, we're going to be discussing reasons why multifamily investors fail. Now, I am an expert on this topic. And you might ask yourself, well, Gino, why are you an expert? Because I failed multiple times. I'm speaking from experience. But as I've learned throughout my journey and as I've seen other entrepreneurs throughout their journey, it's not the failures that define you. It's what you learn from those failures that define you and how you use those failures to fuel you and to re-gauge and to recalibrate what you're doing. I mean, those are just opportunities. Tons of problems with these failures. So in this lesson, in this video, I really want to discuss with you some of those lessons that I learned. And what I'm going to do is I'm going to create this into two parts because there's a bunch of them. So I'm going to go through 5 in this lesson right now. And then in part 2, I'm going to go through the other 5. So I'm trying to categorize these from the biggest to some that are smaller. But this may resonate with you. One that's really big with me, it may not make any sense to you. You may be like, well, that doesn't really make any sense, or I'm not going through that right now. So just have an open mind as I start listing these out. And like I said, some may just pop out at you and go, wow, I'm going through that right now. Before I even go through all of those mistakes, one thing I would like to add. When I started my journey with Jake, we didn't have that map or the process of buy right, manage right, finance right. Now, I don't want to say that was a mistake, not having a process. That may be the largest mistake for most investors. Whether you're buying a business, whether you're investing in real estate, whether you're putting your money into the stock market, whatever investment vehicle, if you don't have a process, a proven framework, something that you can follow, that's going to be a problem. You could still buy 1 or 2 deals, not have a process, and do okay. I did that. But then when I started buying a couple more deals and I started getting a little bit bigger, not having that process of buy right, manage right, and finance right, you're going to see the mistakes you're making. And as I go through these mistakes, each mistake is really, anchored to one of those pillars. Remember the wheelbarrow with the 2 back legs. The buy right is the back leg. Once it's fixed, it's done. The finance right is the other leg. Once that's fixed, it's done. Both of those are stable. The wheel is the manage right of the investment. It's in constant motion. If one of those 3 pillars is weak, guess what? Your investment is probably going to falter. Now, if you've done 2 of those wrong, good luck. I've done actually all 3 of those poorly on a couple of the deals that I imploded upon. So I'm going to touch along these problems or these mistakes that I made, and you're going to see the correlation between not buying it properly, not financing it properly, and not managing it properly. Now, the first one is what I think in this previous market cycle that we've been in from probably 2021 to 2024, 2025, most investors, especially if they're starting out newer, didn't understand what we call operational complexity. Now, it's not that complex to run a multifamily business if you've done it for a little while. When I first started out, it was complex to me because more important than anything else, I didn't view real estate as a business. I thought of it as a collection of assets, and I thought, hey, it's gonna be passive. Well, it can be passive to certain people, but to the vast majority of us, it's an active business. And once again, as I told you, this is the manage right of the business. Not treating it like a business. People were buying these assets, trying to fix them up and flip them real quick. That worked for part of the market cycle until it didn't work. And that's the mistake that I made before I got on with Jake. Looking at every venture in real estate, whether you're buying single family homes, self-storage is the most prevalent one that you can probably see that it's a business. You're renting out space, and every 12 months you're getting new tenants. It feels like a business because people are coming in and they're giving you rent, they're renting out a little storage space, and they're moving out. That may seem a little bit more obvious. But when you are investing in our vehicle of multifamily, you're buying a 10 unit, you're buying a 14 unit. I looked at those as just investments, just as like buildings. But I didn't understand the operational complexity of them. I didn't understand that I was running a customer service oriented business. I didn't understand that. I looked at it more of as a spreadsheet and just looking at numbers, understanding the operational complexity and understanding that it is a business, shifting your mindset. Once I started doing that with Jake and I started understanding that we can't do everything ourselves, we need to start implementing systems. We need to start hiring property managers, maintenance techs, creating all this cadence of accountability and running the business and not just the investment side. You need asset management, but you also need property management and you need business skills. And we underestimated that. And a lot of investors that got in over the last 3 or 4 years, they underestimated it as well. The second one is, gosh, this one bites, I think, every single investor out there. Misjudging renovation and CapEx costs. On my third deal as an investor, I hadn't known Jake yet. We bought a strip mall in New York. It looked okay. I made every possible mistake. Now, this would probably be part of the buy right, but it's also part of the manage right. Because you're looking at a deal and every new investor overfixes on their deal or doesn't put enough budget or doesn't know how to create a budget. And that could really kill the deal. Now, for myself, on the deal, I bought it. Remember, the number was $1,250,000. I probably had to put in another $600,000 or $700,000 at least into CapEx. I had to upgrade the fire systems, upgrade the water system. I had to put in retaining walls. I had to do siding. I had to do parking lots. I had to do fencing. I had to do driveways. I had to do HVAC units, underground oil tanks. It was a gamut. It was so much of a budget. I had to go in and get certificates of occupancies for a lot of these spaces that were there. It was a nightmare. I didn't understand how much money I had to put into the deal. Ultimately, I lost that deal. Not lost it, I sold it for a tremendous loss. Great learning experience. Held the deal for 10 years. But if I had gone in eyes open with the reality of a budget, I probably could have gotten it for a much better price and/or I probably would have walked away. So please make sure that you have a realistic budget. Make sure you bring contractors on there. Make sure you go through your financial and your legal due diligence, understanding what is missing. If you don't have certificates of occupancy, if there's certain violations, I had violations from everywhere, from the Board of Health, from the fire department, from the COs, from the town. I didn't understand. I didn't look at those. I made so many mistakes. So misjudging renovations is important. Now, this third one, this can be corrected rather easily nowadays, especially. It's just poor deal analysis. Not understanding what underwriting is. And every niche of underwriting in real estate is different. You have different expenses. Once again, I'd mentioned self-storage. I think self-storage runs at like a 35%, 40% expense ratio. Now, if we had an expense ratio in multifamily, I hate expense ratios. Give me the per unit cost. Is it $6,000 a door to run? But let's say you want to use an expense ratio. It's much higher in multifamily because we're more labor intensive. We have more property managers. We have more payroll on there. We have more things to break, more CapEx items. So understanding the deal analysis. Over the last several years, this has been another crux, another problem with newer investors. They're going in, they're overestimating income, they're underestimating expenses, and it leads to underperforming deals. Well, at least nowadays, people are using tools that deal that I had talked to you about that I bought back in 05, 06. I didn't know how to underwrite a deal. Looked pretty good to me. I didn't know what a cap rate was. I didn't know what cash on cash was. Debt coverage ratio, didn't know what that was either. Just doing poor deal analysis. If I had stuck with the numbers, I could have said to the seller, this doesn't hit a debt service coverage ratio of 1.2. That's what the banks need. We need to lower our price. They could have said to me, flag kite, in which case I wouldn't have bought the deal. But understanding that deal analysis is so important. And if you don't know how to underwrite a deal, or what's really cool about deal analysis is there's the, overficial, 30,000 foot view. You're just putting numbers into a spreadsheet. That's great. Anybody can do that. Chat can do that nowadays. diving into what those numbers mean and getting the ability to ask really great questions about those numbers is where you make your money in deal analysis. Now, if you want to learn more, just go to wheelbarrowprofits.com, schedule a call with one of their advisors. They can teach you how to underwrite a deal properly, because it's great. It may look good on the spreadsheet, but are those assumptions you're making, are those accurate? Are you looking at a really old building and comparing it to a newer building? Is the market growing? What about the median income? See, this is all about the buy right. And these are a lot of the mistakes that I made, not understanding the buy right and not understanding how to analyze a deal properly. And that's why coaching is great, because if you have a coach and you're underwriting a deal, the coach should be able to look at that deal and, put holes in that deal. They want to make sure that your underwriting is conservative. They want to make sure that you're going into this deal eyes open. And they want to make sure that you've got your analysis down pat. So you're looking at the deal and not just looking at the numbers. It's important to look at the numbers, but you're also trying to fit that deal into what we call your exit strategy. That's really important. Now, this next one is really challenging. And I fell for this one a couple of times. Making decisions based on emotions versus strategic decisions. I need to do a deal. I've got money. This looks pretty good. I'm looking for the best rate of return. Fall in love with the numbers. Don't fall in love with the deal. You need to understand and appreciate and like the numbers. If the numbers don't make sense, it doesn't matter. It's based on your emotions. And as a money coach, there's 3 parts to your brain. We talk about it in money coaching. There is your instinctive or your primitive brain. There's your emotional brain, and there is your logical or thinking brain. A lot of times, newer investors get stuck in the emotional aspect of the brain. When your brain is processing emotions, all of a sudden the logic runs out. Yeah, but it's a 1 debt service coverage ratio. I know I can get up to 1.3. Well, think about that logically. Can you do that? And I'm not saying that you can't, but if you're stuck in the emotions and you're flooded with emotions, it'll never get to your frontal lobe. You'll never be able to make a rational decision. I've gotten caught in that deal that I was just talking to you about. It was beautiful. It was a nice strip mall. I fell in love with the deal. I could envision a nice brand new rehab little, strip center with retail and then offices upstairs. And then in the back, I had warehouses, parking lot. I'm like, this building is great. Yeah, my emotions were taking the better of me. If I had sat down and done the numbers and understood, I'm trying to pro forma the rents upstairs at $1,000 a month for 800 square foot units, which is not a lot, at least in my estimation, but that market didn't warrant it. I couldn't even get $500 a month. So if I had set the emotions aside, let them, calm down and then look at things logically, I never would have done the deal. And I know a lot of investors over the last 2 or 3 years with the FOMO, the fear of missing out, and the get-there-itis, all of a sudden their emotions take a better hold of them and they start doing deals. They start, as we call, pencil whipping deals, trying to make those deals work instead of saying to themselves, do those deals work? And what does that look like? So don't let your emotions take the better of you. Close the computer, walk away for a little while, send the deal possibly to somebody else, have them analyze it without having so much of a buy-in or having so much stake in that deal. Because if you have more stake in the deal, you'll convince your brain and yourself to say, yeah, that deal works. That deal makes sense. I got to do the deal. Once you're at that point saying, I got to do it, that's trouble. Now, the last one. This is a really difficult one for newer investors and even for older investors. Market misalignment. Now, what do I mean by that? Market misalignment. When I bought that deal, I just bought it in the wrong part of the market cycle. If I had waited a year or two, I probably could have bought it for $300,000 or $400,000 less. Understanding where you're buying an asset in what part of the market cycle. There are 4 cycles to a market: recession, recovery, expansion, and hypersupply. Do you remember when I bought that deal? Back in 2006. What part of the market cycle were we in for the vast majority of the US? We were in hypersupply. Assets were priced high. It was a seller's market, not a buyer's market. And I bought it in the wrong part of the market cycle. When I bought it, a year later, we go into a recession, hard turn recession. And not understanding that is important. And if you're looking back at the last, say, 7 or 8 years, back in 2016 and 2017, that part of the market cycle was buy, refinance, flip, buy, flip. And that's where we're in the market cycle. Now in 2021 or 2022, if you're continuing to try that strategy of buying a deal and flipping it in 18 months, it's not part of the market cycle. You couldn't do that. All of a sudden, that stopped. Try refinancing a deal today. It's a lot more challenging. So if you're trying to buy assets and you don't know where you're buying these assets in what part of the market cycle, that's where you're going to make your mistake. Understand where you are. Right now, we're entering a buyer's market cycle. So if you're trying to sell an asset, it may be more challenging to get the price. Right now, in this part of the market cycle, debt is a lot harder to get. It's a lot harder to finance your assets. Understanding that will give you an advantage. Not overpaying in this part of the market cycle is smart because we're going back into a buyer's cycle. Rates are a little bit higher. Understanding all that. If you don't understand the market cycles and the strategies that you can employ in the market cycles, I'll give you one more example. When we started back in 2011, Jake and myself, we're buying much older assets, 1960s, 1970s, and the occasional 1980s. Why? They were very inexpensive. The price per unit was cheap. We were just very lucky that as we bought these, the market took off, asset prices started elevating, and we were just able to refinance these deals. Now, back in 21 and 22, people were buying 1970s assets at a 4 cap. Well, a 4 cap became a foreclosure because as you're buying a 4 cap, interest rates go to 6 and 7, you have negative leverage, number one. But number two, rents didn't go where they were supposed to. You're buying stuff on bridge debt and you get caught. You don't understand the part of the market cycle. What if people have taken all of that bridge debt, if they understood where they were in the market cycle? You were at a high, interest rates were at a low. Sooner or later, it happened sooner, unfortunately for a lot of people, rates were going to jump. So understand where you are in the market cycle. We've done videos. Go to jakeandgino.com. We've done videos. We've done lessons. Go to the how-tos on the 4 parts of the market cycle because it's an important concept to understand. Now, what I want you to do, go to barbaro360.com. That's Barbaro 360.com. I'm a money coach. If you want to understand your relationship with money, if you want to understand how to get into real estate, how to invest in multifamily, if you're feeling stuck, if you don't know how to start balancing your time with money, if you want to get a better relationship with your spouse because you're constantly fighting about money, that's what we do at Barbaro 360. We want to align the finances with the family. And this is all going to help in your multifamily journey as well, because I've seen so many students in Wheelbarrow Profits who are young, who are doing amazing deals. And then I see people who are older who have great balance sheets, great net worths and liquidities. They're not doing deals. They're complaining. It comes down to the relationship you have with money, and I want to help you. Now, before I let you go, this is important. Let me recap these 5 mistakes and check them off. See if you've made the mistakes. And more importantly, if you've got a comment, leave me a comment down below. Let me know what mistakes you've made in real estate. You like the channel? You like the video? Like and subscribe to the channel. Number 1, underestimating operational complexity. Number 2, misjudging renovation and CapEx costs. Number 3, poor deal analysis. Number 4, emotional versus strategic buying. Don't be emotional. And number 5, market misalignment. So those 5 mistakes have focused a lot on the buy right criteria, the buy right of the framework, and also the manage right. Treat it like a business and it will pay you forever. I want to thank you for spending part of your time with us. I know how precious and how valuable your time is. So I want to thank you for spending part of it with us. Next week, I'm going to go over some other expenses. I don't want you to miss that. I'll see you all on next week's How To. Thanks, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.